basics around benefits. And secondly, we're going to talk about coverages that you may or may not know existed. COBRA and continuation, they're two very different parts of the conversation. What drives costs, so you have a little better understanding around that. Designing coverages for your team that attract and retain your valuable employees. And then what are the differences between an HDHP, an HSA, an FSA, an HRA? Our industry is horrible about acronyms. So I'm going to try and get rid of some of that for you today. And then life insurance and long-term care, another acronym. And, you really can earn interest. And so we're going to talk about how that works and help you understand a little bit about life insurance as well. So let's talk about the basics of coverage. Now, a lot of times in small businesses, they say, well, what is required? And then simply put, there is nothing required. You as an employer are not required to provide benefits to your employees. Now, to get competent employees and to retain them, that's when you should really think about coverage. Now, when do you offer coverage? I always tell people that with coverages, if you don't have a 3 to 6 month reserve in your cash, it's going to be a little bit tough for you to offer coverages. And the reason for that is because you've got to plan on about $350 per employee per month. So if you've got 10 employees, you've got to have a $3,500 cash flow just for that. A lot of our small employers maybe don't have that type of coverage. So if you don't, or the ability to cover it. So if you don't have a reserve available and the cash flow to accommodate that type of expense, then one thing you could do is offer to reimburse somebody. But as an employer, you cannot pay for their individual health insurance. You could reimburse them, and that might be a couple of $100 a month, depending on the age of the person. It could be as much as $600. So there's a lot of things that you can do as an employer, but I always suggest that you've got 3 to 6 months of cash reserve for overhead flow in your accounts before you offer coverage. Also, the most expensive plan isn't always the best. We could design a benefit package that has a high deductible health plan that the employer's paying for, and it's a lower cost. And then you could allow employees to buy up additional coverages. How you choose the right benefit for your team can be done by, first of all, asking them, what types of coverages do you want? We can do surveys for our clients to help them understand what benefits the employees might want. But as you design these packages, the higher deductible plans are going to be your lower cost. Low deductible plans, you're going to clearly have a higher cost. The other factor is your population. If you've got a younger population, your costs can be lower because in smaller employers, the population is all that they can base their rates on. So if you've got a lot of 30 somethings, your rates are going to be lower than if you've got some 50 or 60 somethings. So that's another factor in trying to design the coverage. Also, the waiting periods for coverage. This is one of the things that Obamacare changed. We can't really have extended waiting periods anymore. The longest duration you can have is 60 days nowadays. And that would be from date of hire, the first of the month following 60 days. Some employers, if they are hiring employees on a temporary basis, when they switch to permanent basis, that's when that clock starts ticking, but you've got to be really careful in how you do that. And then there's the value added benefits. Of course, medical is the first benefit that employers think of, but if you have value added to those benefits. So what if we provide financial coaching for your employees as a value added benefit? What about the wills and trusts that employees need? That's another value added benefit that employers don't necessarily think about or understand. The employee assistance plan that is often a part of a disability income policy will allow employees to get a will, a power of attorney, a directive to physician at no cost. And then the mental health offerings, this is something that has been very predominant in this last 2 years because everybody is stressed. As much as we might like working at home, sometimes that adds a new level of stress. We've got to deal with the puppies or the children or the other spouse working on the other end of the dining room table. So, or just the loneliness and isolation. So mental health benefits are an important part of the conversation of benefits, but it's important to know that mental health benefits are a mandatory benefit in all health plans. So it's not something that you don't have. It is something that is just naturally a part of the benefit package. Now, obviously, disability income, you probably already knew existed, but a lot of employers don't realize that they could probably protect all the employees at 60% for the same price as it costs to cover just the owner at 60% of pay. And so I encourage employers to use disability income on a group basis to get their individual coverage and then provide that value added benefit to their employees. You've got the Washington State Sick Pay Plan, and it's going to cover, I believe it's about $500 per week, but that's not necessarily going to give you 60% of your income. So often we suggest a disability plan that covers the short term for the first 90 days, in addition to what the state provides, and then long term from the 91st day. And you could do a 2-year benefit to start, 5-year benefit, or a 2 age 67 benefit. When I started, it was 2 age 65, but since the retirement age has increased to 67, now it's 2 age 67. And some carriers are offering coverage to age 70. But remember, the disability income plans provide that additional employee assistance program that gives your employees wills and power of attorneys. Voluntary life insurance, when you have a disability income plan, the carriers that are offering the disability insurance want to add in life insurance. So it might be a $15,000 or a $50,000 life coverage that the employees have, but you can offer voluntary above and beyond that. Some carriers offer guaranteed insurance, so you can guarantee coverage for $250,000. Sometimes it's up to $1 million, depending on the size of the group. But that voluntary life insurance could be incredibly valuable if somebody's got health issues and they can't get coverage. So that's always a thought process to bring in a little bit more value to your employees and try and get them to stay with you. As I said earlier, financial wellness programs, we do talks for our employers on budgets and wills and trusts, understanding the differences between a will and a trust, what life insurance is, how it works. How do you understand how much income protection you have? How do you plan for the future? How do you understand how much retirement income you can have and how long it will last? Financial wellness is one of the issues that a lot of employers don't necessarily think about, but when you start to realize the number one stress factor for employees is money, if you can take that and give them a tool or somebody they can utilize as a resource, it lowers the stress and employees have more confidence. If they know how to get out of debt, that gives them more comfort, less stress, they're happier as employees, and they're realizing that my employer has provided this value-added benefit for me at no additional cost. Critical illness insurance. This is an insurance that pays a benefit to the employees if they are diagnosed with a critical illness, cancer, diabetes, and that benefit comes to them tax-free. Now, most plans in Washington State, oddly enough, are like $50,000. So that's not a huge benefit, but when you have a diagnosis of a critical illness like that, that $50,000 is immediately provided at a tax-free benefit. So that's something that your employees can benefit from, and you can have that paid for by the company, or you can have that benefit paid for by the employee. Identity theft insurance. This is another benefit that a lot of employers don't necessarily think about. But again, fraud is a very relevant issue these days. And so making sure that your employees have identity theft insurance is another value added benefit. And of course, long-term care insurance. This was a big topic last year. Many employers got coverage and some employers said, you know, we're just not going to deal with it. Long-term care insurance is a conversation that everybody should have. Now, whether you're going to pay the Washington State long-term care tax or not, that's not the point. The point is that the $36,500 that the state's going to provide is not going to be enough to cover anybody for any duration. So we should have conversations about long-term care. We should have conversations about what is good planning. And so whether you're providing long-term care insurance or giving the employees access to long-term care insurance, that is a tremendous benefit that everybody needs to think about and evaluate moving forward. Pet insurance. This is a big one. There's been a baby boom since 2020, and there's been a pet adoption boom since 2020. And so employees want pet insurance. Now, that's something that you could offer the employees to payroll deduct. It's not something that I've had many employers really reach out and ask about, but it is certainly something that a lot of employees are interested in. And there are so many choices out there. It's a little bit kind of crazy. Gym memberships is yet another benefit. Some employers are paying for gym memberships to keep the 2020 off or get the 2020 off. So these are just some things to think about. And when you're designing the benefit package, you can design it so that you're adding benefits over time. The COBRA versus continuation. Now, COBRA is federally mandated. If you have 20 or more full and part-time employees in the prior calendar year, and we look at it by quarter, your part-time employees, each part-time employee, 2 of them count as 1 full-time. But if you have 20 or more full and part-time, you must provide COBRA. And you have to provide notification. You have to let the employees know that January of this year, we are now eligible for COBRA under the federal mandate. So you send out notices to your employees. When they terminate, you've got 15 days from the end of their coverage, which is typically the end of the month, to notify them. So whether you do COBRA yourself, whether your broker does the COBRA, or whether you hire an organization, you've got to pay attention to the COBRA. It is a requirement of the employer. And there are specific timelines and there are very significant fines if you don't adhere to the COBRA rules. Now, there's 18 months of COBRA for the employee and 36 months for dependents. And those are independent rights. You can't say to a dependent that they don't have the right to COBRA. They do. And sometimes that can be coming up if they get a divorce or if they're separated or if they adopt. So making sure that you're managing your COBRA is a very important part. And that's one of the things that we do with our employers is we provide the COBRA for them and make sure it's monitored and we get all the notices out and maintain it for them. Continuation is a state right. So continuation, when you have less than 20 employees, that's when continuation comes into play. Then continuation is an optional privilege. It's offered by the employer and it's subject to carrier rules. Most all carriers are going to tell you that it's going to be limited to 3 months. And so if somebody leaves, you can say you can continue on our plan if you want to pay the premiums. and you've got 3 months to find another plan. Some employers aren't going to offer it, but you don't have to. So what are the cost drivers? With small group versus large group, small group is 1 to 50. And in that small group realm, your main cost driver is the population. Employee and dependent population will be critical in getting the accurate rates. If I've got an employer with 15 employees and he sends me the census with 15 employees and no dependents, and then dependents come on the plan, the rates that we gave them are completely wrong. So when we ask for our census population, we need to make sure that we're getting who's coming on the plan. If we've got 15 employees and 10 dependents, the whole population is going to drive the cost of that plan, and it's strictly the age of the population. With larger groups, you can start to ask health questions. For groups over 50, we're typically asking for medical information. And some carriers require every employee complete a medical form. Other carriers are just saying, what large claims are you aware of? Because that also is going to drive the costs from the carrier's perspective. If you've got a group of 70 employees and you've had strokes, or somebody has got a ongoing major claim like cancer, and then somebody else has you've got a couple cancers and maybe heart disease, those costs are going to raise the claims participation, and then consequently your premiums are going to go up, because the carrier needs to make sure that they've got enough premium to cover the claims liability that they're going to face. Now, when you get to groups of 100 or more, those are getting into the larger groups where you can start to get claims reporting. And when I say the medical information, I am not saying that your HR department needs to know the health of all your employees. If you know of no large claims or no issues in your population, then you have to tell your broker that. If you know of somebody who's got cancer, you need to tell your broker, because that's the way that the broker can get the most accurate information for you. The carriers will give claims utilization usually at 100 to 150, depending on the carrier. But below that 100, they're usually not interested in giving out any claims utilization on a group. Then you have trusts versus direct to the carrier. So trusts are using the pool of the population, and it might be a population of architecture firms. It might be a population of just small businesses from 5 to 50. But the trust can pull all of that medical information from all the plans inside the trust and keep their rates under control. When you go direct to a carrier, you're going to be subject to the carrier's small group block or the carrier's large group block, and it's going to drive your costs accordingly. And then, of course, your claims. In a small group, the carriers can't rate based on claims. They can only rate based on the population age. So that leaves you a lot of challenge from the carrier's perspective. If they've got a group of 10 employees and they know they've got one person with an ongoing cancer claim, they can't raise the rates beyond what their entire pool is going to cost. But they know that their utilization is going to be higher, but they can't do anything about it. On a larger group, a group of 50 or more, they can do something about it, and they can raise their rates accordingly. For most of the last, I guess 10, 12 years, we've seen rates fairly calm, between 5 and 7% on most of our groups. Occasionally we have a bad year where they might get a 10%, or we've got a population in a group that whose average age was maybe 40 in one year and now it's 50. That causes a big rate increase. But if your population doesn't change, the rate increases have been fairly consistent over the last 10 years. So your claims and utilization are are a big part of your larger size groups. Is there a question, Brittany? Okay. And I talked about the age of the population. So designing benefits for your team. This is when we can start to get creative. Now, when you first want to create a benefit package that's going to encourage employees to stay with you. And one of the ways that we suggest employers do this is by designing the benefits so that the longer an employee is with you, the more benefit you're providing for them. So let's say an employee is hired and you pay 75% of the cost of their medical and dental for that first year. And then in year 2, maybe you say, we're going to provide 85% of your medical and dental premium. In the third year, it might go to 95%. In the fourth year, 100%. The fifth year, you say, okay, we're going to now provide you 25% of your dependent costs. So what you can do is design packages that increase in coverage as far as the premium goes over time. You could also say that as you're designing your new benefits package, if you don't have a benefits package, you could start with medical and dental. You could add disability. And it's always interesting because some employers add dental, which is about the same in cost per month as it is for disability income. Now, disability income is going to protect 60% of their salary for a 5 or 10 or 2 age 67, but dental is going to give you about $1,500 of benefit per year. So what I want you to think about is, what's the real value? Is the dental insurance, or is it protecting their income? And so I would contest that protecting their income has a more significant value, but for some reason the employees think that, well, I want to get that $1,500 of dental work done. So I'm just saying, you might want to think outside the box when you're designing benefit packages. Graded benefits are great to offer based on time served. And that's really the only way that you can do that. You can't say, I'm going to provide this for the owner and this for everybody else. Doesn't necessarily say anything but discrimination. So say if the owner and a couple people who are on salary have been here the same amount of time, you could say, if people have been here for 4 years, we're going to provide this much of their premium. Maybe it's 100%. But don't say the owner is going to get 100% and everybody else is going to get 50. The carriers don't like that. So we want to be careful about how you design your benefits based on the groupings that you're doing. As I said, increasing the cost coverage paid by the employer, adding benefits over time. So maybe we add medical, dental, and the next year we add vision, and next year we add disability, and we add voluntary life, and we can continue to add benefits over time to give people more value. When you think about a 401k, for example, many employers will start with a 5-year vesting. You can do the same thing with your medical benefits. Once they're there 5 years, they've got 100% coverage. So there's different things that you can do with regards to that. As I said, the different coverages for different groups of employees. You could have hourly have a benefit at 75% and salaried have a benefit of 100% of coverage, or you can have salaried with so many years of service at 1%, salary with another year of service at a different percentage, and then hourly at another percentage. So you can be creative that way. And then you can offer more than one plan. So that's what I said earlier, is if you design a benefits package and you've got a high deductible health plan, some of our carriers allow you to offer all their plans, or we can say, okay, we're going to offer plan A, B, and C, but we're going to pay for plan A. And then employees can payroll deduct plans B or C. And we just talked about how you design them correctly with the time of service and whether you're salary or hourly is maybe the keynotes, or you could have managers and non-managers. You can have supervisors and non-supervisors, but you have to have a group of employees that you can clearly delineate the differences, and it's not based simply on ownership. So the acronyms: a high deductible health plan. These are plans with higher than normal deductibles and no copays are allowed. You can have a 3,000 deductible, but have a copay for office visits. So that's not a high deductible health plan. High deductible health plans are significant because you can have a health savings account with that. So the health savings account allows the employee and or the employer to make contributions. You cannot be covered by any other health plan. You cannot be enrolled in Medicare, not covered by a spouse or an FSA account. And the contributions are pre-tax. So an individual can pre-tax $3,650 into that HSA account, or $7,300 for a family, and they can pay all of their expenses tax-free. So and it seems to be an interesting conversation having this with an employee who's like, well, I don't know how much I want to put away. And when you start to understand all the things that you can deduct into your health savings account, and I went over this with my daughter, and so sorry guys if this offends you, but even tampons are a tax-free expense. And my daughter's like, really? And her supplements prescribed by her naturopath are a tax-free expense. And so, she's into February. She's like, I've already used all my money up, Mom. I'm like, I know, I told you to put more away. But when you can help the employee understand that $3,650 tax-free is significant, and if you don't use it, it's still yours. You don't lose that money. You can keep building it up. If you get so much in there, you can actually invest it and have it accumulate. And so that at 65, you could use it for whatever you wanted to, still tax-free, but you can use it to pay Medicare premiums. You can use it to pay long-term care expenses. So HSA with a high deductible health plan is a great strategy, and explaining it to the employees can be a little bit challenging, but we've done it successfully. And then you have the HRA, a health reimbursement account. A health reimbursement account is employer funded. You have tax-free withdrawals for reimbursed medical expenses. So a classic one is a medical health reimbursement plan. So I'm a small employer and I reimburse employees for $1,000 for their dental expenses each year. So they give me their bill and I reimburse them. But I don't pay for the premium because I don't have a dental insurance plan. But it's just a way for me to have dental coverage for my employees, and I just reimburse, and they might use the same amount of premium I would have spent, but they're getting more benefit for it because it's not going to the insurance company. Most insurance on dental is a profit zone for the insurance company. It's just putting it out there. So when we've got an employer that's got 25 or more employees, I'm always telling them to self-fund their dental through a dental administration only plan, because they're going to keep all of that profit in their own pockets. And it might cost them maybe $8 per employee per month instead of $40 per employee per month. And then they have the claims utilization, and the claims are typically maybe 25. So by the time you pay $33 a month instead of 40, you're keeping that $7 per month per employee in your own pocket. With a health reimbursement account, you can carry over any unused funds. They're just reserved. You're administering it. It's administered by the health plan. A flexible spending account is set up by the employer. There's carryover potential, but it's limited to 570. And that's decided if the employer wants to allow it. An FSA is a use it or use it type of plan. So with FSAs, you've got to be really careful about what you're putting in so you don't end up with a whole bunch of extra money there. So The contributions are declared once per year at open enrollment, and they're limited to $2,850 for a single and $5,700 for a family. You can have a flexible spending account or an HSA, but you can't have both. We're going to talk about life insurance. And this is always an interesting conversation because there's term insurance and there's permanent insurance. There's strictly two kinds of life insurance. Term is like renting and permanent is like owning. You build equity every time you make a payment on your permanent policy. And with term insurance, it's gone. It's like kind of flushing the toilet. It's just gone. It's gone forever. You won't get it back. The value of owning permanent insurance is that you have tax deferred growth on the money inside the policy. You have tax-free distributions on the money from the policy. You have a competitive rate of return. Now, people might not think that 4 or 5% is a competitive rate of return, but when you consider what your savings account's paying you, I would say that's a pretty competitive rate of return. You have high contribution limits. So with life insurance, you can put as much into a life insurance policy as you want. This is important for owners to understand because as an owner, you can do a lot with life insurance, such as non-qualified deferred compensation for key employees. And high contribution is what you're deferring into the life insurance. It's growing tax deferred. The employee is going to get that money, or you as an employer get the money at tax-free distribution, and then you can pay the employer a tax deductible. But the real key thing is that you've got additional benefits with life insurance. Of course, you've got a death benefit, much higher than what the premium is. You've got, in some cases, long-term care benefit. You've got protection from creditors and protection from lawsuits. So life insurance becomes this incredible tool. You can collateralize a permanent life insurance policy. It's safe. There's a no loss provision. So you can watch the market go up and down in your 401k. You can lose 30% on one day and hope it comes back in a year. With life insurance, you have a no loss provision. So once you've earned the money and it's there, they cannot take that account value away from you. So that's an important feature to the life insurance policy. You have guaranteed loan provisions. It's a contract between the owner of the policy, whether the owner is the employer or the employee or the company. You have a contractual provision to be able to borrow against that policy. So if let's say as a business owner, I've got a policy on myself that is owned by the company and I'm putting money into it, it's an asset on my books. The cash value of that policy is an asset on my books. So when I want to borrow against that policy, I just call up the insurance company and I say, oh, I want $10,000 as a loan against my policy. They send me the $10,000. So now I've got a loan against my policy, but I've still got cash in my policy earning interest. So I, as an owner, am paying myself back at interest to access that money. The only thing that life insurance is not is deductible. You've got liquidity, use, and control of your money, but it's not deductible. Because if you think about it, if you deduct the premiums you put into a life insurance policy, then the reward becomes taxable. Because remember, Uncle Sam is always over here saying, I want my share. So if you're not going to pay it today, you're going to pay it tomorrow. So I would much rather pay taxes in a known bracket today, because I don't know what the tax bracket's going to be like in the future. It could get back up to that 90% that it was in the 60s and 70s. So I would forgo deductibility to have tax deferred growth and tax-free distribution. Oh, tax deferred growth and tax-free distribution. That sounds just like a Roth, doesn't it? With a competitive rate of return, except after that, all these other features are not part of a Roth. collateral, high contributions, disability, long-term care, protection from creditors, that's okay. But you don't have the no loss provision in a Roth. You don't have the safe harbor. You don't have the guaranteed loan provisions or liquidity, use, or control of your money. So where a Roth stops, a life insurance policy can continue. And with the predominance of long-term care last year, what a lot of carriers are doing is writing life insurance with a long-term care rider attached to it. So you've got your life insurance, and then you've got this rider that says, okay, if I need long-term care when I'm in my 80s, I can use 2 or 4% of the death benefit as a benefit to pay for my cost of care. So, and if you don't want to pay for the rider, some carriers have a critical care benefit that says, okay, you're not paying for the rider, but if your policy is worth $1.5 million when you're 85 and you have a long-term care incident or are stricken with Alzheimer's or dementia that requires severe or supervision, you can take that benefit and receive a long-term care benefit because you qualified. So unfortunately, and this is one of the things I'm hoping the state figures out, is they've got the long-term care rider as defined in section 7702 as what has to be in place as of November 1st. I'm hoping they realize that along the way, people may buy long-term care insurance and no longer want to pay the tax. And if they would allow you to waive off of it, why wouldn't you? But they're still trying to figure out the whole tax situation. So life insurance is a tremendous tool for an employer and for anybody who wants some tax-free retirement income. We just have to design the policy the right way. Now, I've taken about 42 minutes of this hour. So what I want to do is I want to open it up. I'm going to stop sharing because I want to open it up for questions. And if you guys have any questions, I want to make sure I have time to answer them. And I know you're all still eating and enjoying your food, but if you're not, I'd love to see your faces.
You did fantastic. So I just want to start with that. Amazing job.
Thank you.
I loved the section on the long-term care. And when we went and got ours, we did the group because the individual plans were closed with the long-term.
Mm-hmm.
And I think the interest part was super appealing, but isn't there like a cash value? But 65 is when it fully matures, but you can take out prior to, if it has the death benefit and the long-term care, you can kind of redeem them before 65, I think is that sound right?
So with long-term care insurance, the only way you can get long-term care benefits is if you qualify based off of a loss of 2 activities of daily living,
yeah,
or diagnosis of severe cognitive impairment that requires supervision.
Yeah.
That's the only way you receive long-term care benefits. Now, when you have a life insurance policy that builds value and has a long-term care rider on it, you can actually access the value whenever you want. You could do it at 59.5, or, I mean, I've used my policy in multiple occasions. Now I'm using it to pay for my daughter's wedding. So, there's really no limit on how many times you can use the values internal to your policy.
Awesome.
But the long-term care rider will be affected by how much you would borrow against. And the reason I say borrow against your policy instead of liquidating it is because when you keep those dollars in the policy, that is what protects it from the taxation. So you can withdraw up to your basis and then borrow beyond your basis, but you never, ever, ever, ever want to let your policy lapse.
Yeah.
And some carriers have a no lapse protection on there that they will trigger it. If the policy gets too skinny, they'll trigger the no lapse protection rider. And so you can't let that policy lapse, because what would happen is if I took out $1.5 million out of my life insurance policy over my lifetime and I paid $400,000 for it, I'd have a tax of 1.1 million the day it lapsed.
Yeah.
So that no lapse protection rider makes sure that I never have to pay that tax.
That's awesome. And then when an employee separates, it's kind of like COBRA, well, at least our plan is, where they have the option to continue to pay into the premiums to continue. Is that typical?
Yeah, so did you get like Allstate?
Yes, yeah,
Yeah, okay.
yeah. Before you. Yeah.
So Allstate is a whole life insurance policy that they're basically billing you on a payroll deduction basis.
Mhm.
And so its contract is owned by each individual.
Got it.
And so even if they had a group plan, a traditional group long-term care plan, the employee could take that premium and continue that premium, no matter what carrier they had. Some carriers build value, others do not. It's just dependent on the case by case basis.
Good information. Thank you.
Sure. Are there any other questions? I love answering questions, by the way.
She loves calling people out if nobody asks questions too.
I have a question.
Sure.
So we pay 100% of our employees medical and all that. But for the first time, we actually did look at those health savings accounts,
Mhm.
or the one where you were talking about how you do your dental.
Oh, the health reimbursement account?
Okay, the health reimbursement account. Yeah,
Sure.
we looked at that as an option, as a way to offset some of the premium costs without reducing benefits. So instead of asking them to pay for, I forget how we were looking at it. Anyway, I was just wondering if you could talk a little bit more about maybe any pros and cons about that approach, instead of
Yeah,
just,
with the
instead
health
of sharing the
reimbursement,
premium.
with the health reimbursement plan, what you're typically doing is, so some employers will create a health reimbursement account that says we're going to provide a maybe you had $1,000 deductible and now you're going to a $1,500 deductible, and we're going to provide $500 of reimbursable expenses. Once you've paid your $1,000, then we're going to reimburse from 1,001 to 1,500 for you, so that you don't have any new expenses, but this is keeping our costs down. And so the employees have to submit it. So the good thing about that is when you create the verbiage that way, they're not losing any benefit because they still have the same $1,000 deductible, and you're only paying from 1,001 to 1,500. So what you have to do though is you have to set aside the dollars during the year and then reimburse them as they come in, because somebody could use those dollars in day one. And so you've just got to make sure that you've got that reserve. And one of the things I find with smaller employers is it's kind of a challenge if they think they can go like on this modified self-funded concept. They forget to fund those things. You've got to fund them as if they're going to come in, and at the end of the year, you can reconcile your books and say, oh, look, we funded for $100,000 and we actually only spent 50. So then you can journal entry and put it back in the accounts, or hold it for the next year if you've got any, ongoing claims that you need to deal with. But I always just, my company is small enough where I can mentally note, okay, I've only paid $1,000 for $2,000 of benefit, so I'm good with that. Did you end up doing the health reimbursement account?
We didn't this time around, but that's what it was. It was the deductible change to lower the premium. That's what we were looking at.
Yeah.
So no, we did not choose that option, but it was the first time we really looked at it with our broker as an option. And I was just curious as to, like, in the real world, how does that actually work?
Yeah. And when you do a dental plan, like an administrative services only dental plan, what we can actually do, and we do this often with our groups, is we can compare at different utilization levels where you'd break even. Dental is really easy to do it that way.
That's awesome. One thing that might be helpful to touch on, because I know you and I are new to working together this year, but what we've had in the past is we've had a couple employees who became eligible for Medicare. And so we kind of came to that where the rates were triple, and we had to basically make a policy that if you're eligible for it, well, reimburse at 100% rather than continuing on the plan. But it gets tricky with age discrimination and so, maybe any
Yeah, you
strategy.
can't, so with Medicare, you can't force them on to
No.
Medicare.
No, yeah.
You can encourage them by saying, if you want to go on Medicare, I'll reimburse your Medicare expenses or your Medicare premiums for, 100%.
That's what we
Because,
did. Yeah.
Typically half, well, depending on their
Yeah.
income. So if you have somebody who makes a good income
Mhm.
and they're going on Medicare, then you might only save about 20% because they're going to be taxed that Medicare income tax that's on top of the Medicare premium. And so, you could have somebody you're paying $1,000 a month for, and they only are saving you $200 a month by going on Medicare. Still $200 a month, $2,400 a year, but you need to understand how their income relates to that Medicare cost, because their income will dramatically impact that Medicare cost.
So
Will the
that,
employee need to like provide any medical information to you? So to back up, sorry. So the scenario is you have an employee who's aging into that Medicare eligible. You just want to have a friendly conversation. If you choose to go that route, the company can provide you extra cash in your paycheck that if you want to use it to cover premiums, like, are you just sort of saying like you could use it to cover premiums, or is the employer getting involved in paying the government?
No, the employer is not getting involved in paying the government and cannot get involved in paying the government. The employee's Medicare premiums come right out of their Social Security check,
Right.
or they are billed that. So if I think the premium for Part B is like $255, I think, somewhere around there. But the Medicare premium tax could be another 200 and some odd dollars. So if you tell the employee, it might be worth you having a conversation with somebody who specializes in Medicare to help you understand what your coverages could be. And here's why. If you go on Medicare and you've got a good Medicare supplement, you have no out of pocket.
Right.
So you can go get all your services done and no out of pocket. So even for me, when my husband went on Social Security, I'm like, okay, I'm not saving a whole lot of money, but I am, because all of his coverages are covered in full. And I've got a $3,000 deductible on my plan. So, and he would typically meet that deductible because he's always getting something done. So when I put him on Medicare, my costs went way down from the out of pocket that I had to pay. And so what I suggest employers do, and you can always introduce them to us because we do Medicare too, is have that employee have a conversation and just learn about Medicare, understand what the
Right.
privileges are, what the costs are. Because if you've got a Medicare premium of $255 and this person wants a Medicare Advantage plan, which is a zero cost, your coverage cost goes from $1,000 to $255. And you can say, look, I'll reimburse you for that. I'll reimburse you for your Part B and your Part D and your Part D premium. You're still going to be way ahead of the game, but the employee is also going to have significant increase in benefits, depending
Right.
on the plan that you've got.
And so what I'm learning is that those premiums are set by the government. So it's not a question of the employee having to go through a medical
Oh, no,
exam
hell,
and be like, yeah, okay. So that there's not really a risk to the employee to say like, I'm ready to go on that plan.
Right, but I will say, little caveat here is there's an open enrollment period. And so if they haven't lost their job, they can't just go on willy-nilly. Sorry, it would be in during the open enrollment period that we could look at that. Or if they have a birth date and they turn 65, what I always suggest to my clients is 90 days before you turn 65, that's when we should have a conversation. So that, well, Mariah should have the conversation with him because she's the one who's licensed with Medicare. I know enough. I can't legally talk to people about it, but I can educate people about it. Who knows? So they have a conversation with Mariah about what their Medicare options are. And what she does is she finds out, well, what doctors do you see? Where do you want to see doctors? Do you want doctors anywhere in the country? Do you go to Arizona 6 months out of the year? Do you go to Florida 6 months out of the year? How are you using your health plan? And that's really where a knowledgeable broker can help you, because we're not just saying, okay, here's the plans. We're wanting to find out how you're utilizing your coverages. And if we understand it, then we can make recommendations based on the things that you're using your coverage for. It's the same thing with dental. If we know that people have a dental plan and this dentist that most of the group uses is not a part of a network, we're not going to recommend that plan. So we want to know, what dentist are you using? And that's just to make sure that you've got a benefit that people are finding of value. It's the same thing with Medicare.
Sorry to interrupt, but I just want to let you know we've got about 4 minutes left. So if you have any questions, and anybody's welcome to stay on a little bit longer if you've got more time. I just want to piggyback on that, Carrie, because when we had a presentation with you, you brought up an interesting, just a suggestion where sometimes we can get a claim benefit summary, or even just to see what's being used. If you offer pet insurance and you can see, okay, how many people are actually using this? Is it worth the cost? So like having a way to track the benefits you offer versus what's actually being used, and seeing, what people value. Every generation has different items and things that are important to them. So I love that when you and Mariah were on ours, that was a really great thing that we're doing now.
Yeah. Thanks.
Yeah. All right.
If anybody wants us to, review what you're doing or have a conversation, I believe that Brittany's giving you my contact information. Feel free to reach out to me. You can contact us via our web portal. There's a book an appointment right there. You can always book a half hour or an hour appointment just to have a conversation. We'd love to help you.
Well, you did amazing. So thank you. And thank you everybody for joining and your active participation. We'll follow up in the next day or two with the recording and handouts from Carrie. So with that, we hope to see you guys in March. We have With the Finance with Jessica Hickey, who is very close to Carrie as well. So we're super excited. Thank you guys for being part of the SDA family. And until next time, have a good day. Thank you again.
Thank you.
Thank you,
Bye,
Carrie. Really
everybody.
nice.